Welcome everyone to another webinar brought to you by optionsland.com. Today's webinar being presented on December 19th, 2023. I believe this will be the final webinar of the year 2023. So it was a good year. Sorry to see it go, but let's welcome in the new year coming up. Brand new, fresh set of webinars coming up here starting January 2024. We're going to get started right away. I believe the first webinar will be the first trading day of the year of 2024, January 2nd. So I'll look forward to seeing you then. In the meantime, I'll wish you all happy holidays. Hopefully I remember to wish you that same thing again at the end and close of the webinar today. But just in case I forget, there you go. Wishing you all the best. Hi, Wayne. Michael. Hi, John. Albert. Dennis. Hello, everybody. I can't name all the names now, but welcome to everyone. All right, let's move on and let's see what we can get done here today. Before we can get into the webinar, we need to get through the legalities. Please read and understand the CFTC rule before you risk your hard-earned money in the markets. Our disclaimer tells you that we are not registered investment advisors. We are not licensed financial advisors. We do not provide investment advice, nor do we make investment recommendations. The webinars that we provide are for educational purposes only. Especially the detailed trades that I lay out, and I do lay them out in detail, don't I? Those detailed trades that I lay out are not a recommendation for you to engage. They are for illustration purposes and educational purposes only. And we're going to get into some detailed trades here today, I hope. But I got a lot to cover, so I'm going to have to breeze through a bunch of this stuff. We're going to go really fast so that we can get into, I want to review the trades from the last webinar and see how those worked out. And then we're going to talk about low EVR stocks. Last webinar, we talked about high EVR stocks. What is EVR? Well, we'll get into that in a minute. How about right now? Well, wait a minute. Before I do that, let me introduce myself. I am Marco. This is my email address. Please feel free to shoot me an email. I personally will answer your email, and I will do it promptly. So do not hesitate to send me your questions, suggestions, even your comments. Constructive criticisms are always welcome. What is EVR? Earnings volatility rating is specific. It's something that we designed at optionsland.com. It is, think of beta. If you think of beta, most traders understand what beta is. Beta is a comparison that measures a market's, a stock volatility to the S&P 500. So if the S&P 500 is presumed to have a beta of 1, so it is the standard. Everything is measured against it. And if your stock has a beta that's higher than 1, that means it's more volatile than the S&P 500. If it has a beta that is lower than 1, that means it is less volatile than the S&P 500. So if the S&P 500 moves up 1% in a day, a high beta stock might move up more than 1% of its own price. in that day. A low beta stock might move down. A low beta stock might move up less than 1% in that same S&P 500 1% day. So now, earnings volatility rating is similar but not the same. But an earnings volatility rating measures how volatile a stock is to its earnings event. So let's jump over to optionslam.com and let's go over to the stock screener. And let's use my generic screener. In the last webinar, I laid out the exact parameters of my generic screener. They're all right here. But I spelled them out right in the PowerPoint. And when I run the generic screener today, we're in kind of a slow season and we only get 4 stocks. Why are we talking about low EVR stocks? Look at EVRs right here in this column. EVR, not similar to beta, but different. EVRs run from 0 to 10, so they have a 0 to 10 rating. Low EVR is 0, high EVR is 10, and we have a Micron. Are the 2 stocks that I intend to pick on today? Is a fairly low. It's not super low. Actually, it's fairly average. Average EVRs are between 1 and 3 to 3.5, depending on how you want to think about it. As you can see, anything when you get over 3.5 or 4, now you're getting into a more volatile stock. We looked at high EVR stocks last webinar. Foot Locker and OKTA, and Foot Locker, both high EVR stocks. And we designed some trades on them. We're going to review those a quick minute here. But today we're going to talk about low EVR stocks and how we might trade those somewhat differently than high EVR stocks. Okay. All right. So back to so EVR, earnings volatility rating, 0 to 10, average is 1 to 3.5. That was where most stocks are going to fall, in the 1 to 3.5 zone. All right. Okay. So moving on. Now, these are some slides I pulled from previous webinars, because as we design option strategy, and that's what we do as traders, we design option strategy, we need to keep in mind certain things. So let me breeze through these slides, because we have seen these slides before in some recent webinars here within the last, I don't know, certainly within the last year, if not even within the last 6 months or so. When designing option strategy, we need to take into consideration certain things. We need to keep in mind certain things. What are we expecting the stock to do? Well, we want to assess by going to optionslam.com, is this a high EVR stock? Is this a low EVR stock? You know, do we expect a big move? An earnings volatility rating, does it have a high EVR where it moves like Foot Locker? Let me just illustrate that for those of you who might have missed that. If we jump over to, let me go to open this in if I jump over to Foot Locker, just to illustrate what happens with a high EVR stock. Here's Foot Locker with an EVR of 7.2. See that, 7.2? What did I say? Anything over a 3.5 or 4 is considered a high EVR. Well, 7.2 is very much a high EVR. Why does it get a 7.2? Because look at how this stock moves. The one trading day after an earnings event. Here's the earnings event. Here's the one trading day. The max move was 21% in one day. It closed up 16%. And look at some of these other moves. 36, 28, 11, 17, 25, 11, 36 again, 14, 30. These are huge moves. This gets Foot Locker a high EVR rating. In fact, if you look at the EVR history, you can see this thing is at the highest it's ever been, people. So anyway, that's just an illustration of high EVR. Okay, what do we need to keep in mind? Expectations, direction. Are we bullish? Are we bearish? Or maybe we don't have a bias. Maybe we don't think the stock, maybe we think the stock is going to go sideways. Things to keep in mind when designing option strategy. Now, if I'm bullish or if I'm bearish, do I think it's going to move far? Do I think price is going to have distance? Is it going to go a distance? Or is it just modest? Am I just modestly bullish or modestly bearish? And how much time is it going to take for this stock to reach my expectations? I need to keep all of these things in mind when designing option strategy. Implied volatility changes, very important at earnings time. Very important at earnings time is IV, because IV is building as we approach the earnings event. It is crushing, dissipating, getting crushed, getting deteriorated, dismantled, and a bunch of other D words once the news is out. Some reminders to assess these considerations and keep all these things in mind. Here's some tips on what traders should do. Consult Option Slam for important considerations such as what is the EVR, where are the implied move numbers in relation to previous events. Implied move numbers are a direct relationship, have a direct relationship to implied volatility as we're approaching an earnings event. The higher the implied volatility, the higher the implied move is going to be. Implied move is calculated based on the at-the-money straddle price. We'll be talking more about it. Are moves faded or extended? That's the post-earnings page at optionslam.com. Go to the post. Every stock has a bunch of different pages that you can go to. Right now we're on Foot Locker. We have the earnings history page, the trend analysis page, the implied move weekly, implied move monthly, and the post-earnings page. These are all pages that are dedicated to this stock. No matter what stock you type in up here, you're going to get multiple pages. They won't all have implied move weekly. Okay? Because not all stocks have implied move, have weekly options. Are moves faded or extended? Well, that last page I just pointed out, post-earnings page, that's where you get information about how long does the earnings move have an effect on the stock. Is it extended or is it faded over the coming days and weeks? Backtest. We're going to use the backtest module today. Wait until the final trading hours prior to the earnings announcement to finalize your trade strikes. Oftentimes we're here and we illustrate trades on XYZ stock, and the earnings are not today. We're illustrating trades on stocks that maybe the earnings is tomorrow or the next day. And if that's the case, you need to wait until the final trading hours of tomorrow or the next day. You want to, for a through the earnings trade, you want to wait until the timing is right. I don't know where the stock is going to be trading tomorrow. Why would I put my trade on today? How can I choose the proper strikes today when I don't know where the stock is going to be tomorrow? So I'm going to wait until tomorrow, a couple of hours before the earnings event, assuming the earnings event is tomorrow after the close. Okay, I think I made my point. Initiate a day trade mode price chart to assist in managing the trade. If it's a very short-term trade, which is kind of what we've been focusing on lately, using the front week weeklies, then you need to go into day trade mode to manage your position. And you can't go into day trade mode looking at a daily chart. You need to go into a 5-minute chart or a 15-minute chart. Or some of you might even want to go to a 1-minute chart. That's a little bit too crazy for me. Personally, I like the 5 and 15s, but let's move on. Directional bias, which way do I expect the stock to go? Distance, how far do I expect the price to move to be? Operational Greeks are delta and gamma. Timing, how long do I expect it will take to reach my targeted price area? How much time shall I give it to reach my targeted price area? Expiration cycle choices is what I'm talking about here. Choose the proper expiration cycle to meet your expectations. Operational Greek here is theta. Implied volatility. How much will IV change as I approach the earnings event, and how much will IV crush once the earnings news is out? And we've talked about this in some great detail recently in previous webinars. Operational Greek here is Vega, and this is a diagram just to illustrate how implied volatility is multidimensional. And it is not just a matter of anticipated movement, but it is also takes into consideration time to maturity, how much in or out of the money my strikes are, the moneyness of my strikes that I'm choosing to implement in my strategy. And so, not to get too much into it, but to illustrate and let you know that options are very flexible, and we can design strategy really well and control risk with options because of the complexity of them. However, I don't want to scare anyone away. They're not so complex. It's not rocket science. Like I always say, there's only 2 things you can do with options, and there's only 2 kinds of options. There's puts, there's calls, and the only 2 things you can do with them is you can buy them and you can sell them. So it's not all that complicated. Let's move on. Now, this is a screenshot right out of the last webinar where we designed a strategy. And we said Okta is a high EVR stock. And we designed a reverse iron butterfly. And here it is populated down below. We bought the 73. This was right before the earnings event. This was, they're going to be reporting that day after the close. I believe, if I'm not mistaken, let me just jump over and see. Let's see what Thinkorswim says. Right there's Thinkorswim. Before the open on the 29th. Okay, perfect. Okay, so that's the same as after the close on the 28th. All right, so, and this was the 28th. I'm 98% sure. Could be wrong, but I'm pretty sure this was the 28th. Let me look at the calendar quickly. I guess it could have been the 27th, but sometimes we have these webinars on Monday. But anyway, we modeled this trade up during the webinar, and we said this was a highly volatile stock. Let's buy a straddle. So there's the long straddle, okay? But we changed it because there's too much risk in a long straddle, and they're too much subject to implied volatility crush. So just the long straddle by itself is not something that I promote. Instead, I say, if you want to buy a long straddle, I'm going to suggest you consider at least partially entering into a reverse iron butterfly. So this was for a high EVR stock. Okay. So buy the straddle and then sell the out of the money strangle. This reduces risk enormously because look at how much risk there is, $8.65 of risk in just the straddle. But bring in $519 of credit against that debit, reducing the risk to only 300 and some. Look at the next slide. Here's an illustration of that straddle. This is just the straddle. I thought I grabbed a screenshot of the overall trade. Sorry, I missed that. I don't think I got that. Don't think I got the of the reverse iron butterfly. This is just the straddle. At least it looks like just the straddle. Could be hidden behind here. Wait a minute. But that's not check marked. So I think this is not, okay. So let's see, yeah. Well, anyway, here's what I did. I went ahead and I put the trade into OptionSlam's backtesting tool to see how that trade turned out. All right, so here it was, November 28, 2023, the day of the last webinar. The stock was trading for about $72. We went long the 73 put, we went long the 73 call, and then we sold that strangle. So here is the short put, the 69 short put out of the money, and then out of the money on the upside from 73, we sold the 77 call. The net difference was the debit of the straddle minus the credit of the strangle. Our net debit was $349.50. Well, OCTA did not move the first day. Let's take a look and see what happened to OCTA. And we'll just zoom right in here. We can see here's the earnings day. Okay, each candle is a daily candle here. And here is the stock closing at about just under $73 the day before the earnings event. This is when we're designing our strategy in the last webinar. And what did the stock do? It opened at about $70 and it went all the way down. And if you were in day trade mode, you could have captured profit the very first day, that morning. And sometime during the day, the stock went up to here, but it ended up closing not very far away from where it closed the day before. Let's go back. And then while we're here, let's just see what it did the very next day. It went down and closed even lower than the previous day's low of day. Okay. All right. So here's some price chart history of what happened. And then the next day, it reversed, faded the move completely, and closed higher than the pre-earnings day close. All right. So let's see how that affects this reverse iron condor, reverse iron butterfly in this case. Stock was at $72.61. We paid $349 net debit for the reverse iron butterfly. The next day, the stock closed at $70.77. Had we closed our trade at the end of that day, now I said during that morning we could have gotten in, we could have captured profit that morning, but it was not available at the end of the day anymore. That trade lost $51. But then the next day, remember, the stock tanked and went down even below the lower, the one day after. The second day after the earnings event, the stock actually closed at the low, and there was $53 of profit. But then the next day, things reversed and the stock shot up and it closed just slightly higher. Remember, we need this stock to move for this strategy. And I wish I had a diagram, an illustration of this, how this would look. But I have it on the next stock. So let's just move on. So anyway, there it is. And then here now we're getting into the December 1st. December 1st is the expiration day of these contracts. See that they all expire December 1st. So these are the front weekly contracts. And now IV crush really comes into play. And if the stock hasn't moved substantially away from where it closed this day, and as you can see, it's very close, it's only $1 away, this is going to suffer very large losses, okay? Because that's the IV crush, theta decay, time decay, implied volatility crush, all coming into play, not being offset by the delta move. Boom, big loss, $286 against the $349 risk. Not a total loss, but a big loss. Let's move on to the next trade we illustrated. That was Foot Locker. Now we looked at Foot Locker a little bit ago at Option Slam, as well as in it was at Option Slam. We looked at how huge the moves are. So here's another one. We thought, okay, well here's another one. We could try a reverse iron butterfly. Well, the stock was trading right between the $24 and the $23.50. It was like at $23.75, $23.85 at the time we designed this trade. Right there, you could, whoops, what did I do? I mean to do that. Sorry. Let me see if I can find my place. I clicked something by mistake here. There we go. All right, we are back. So this one, I didn't run the back test on it, but let's just review the trade. And in the interest of time, maybe I won't run the back test right now, although I really want to. Now, I think we might have time to do that. Okay, I think we have time to do that. We'll do it. All right, so let's just look at the trade here first. This was at the time during session. This is a screenshot right out of the webinar recording. Okay. Yes. Yeah, we record all these webinars. Let's go over to the resources tab at optionslam.com, and you can see right there's Option Slam webinars. And if you click on that, you'll see there's, I don't know, I want to say hundreds. I doubt that there's hundreds, but there's lots and lots and lots of webinars, like the one that you are participating in today, that are found right here under the resources tab at Option Slam webinars. All right. And today's session is also being recorded. It will be cataloged there as well in the Option Slam webinars archives. Okay. All right. So now, since the stock was not trading right at a strike, we just kind of cheated a little bit and made this a reverse iron condor. Think of it this way, just picture this upside down, it would look like an iron condor, right? Well, this is a long iron condor instead of a short iron condor, or it's a reverse iron condor. Instead of selling the strikes that are closest to where the stock is trading, we buy those strikes. We buy this Strangle, the 24 by 23.50 call by put, and then we sell something that is out of the money to bring in a credit to what I labeled this, by the way. I think this was called in the webinar archives, if you want to look up a complete discussion on this strategy. I think I labeled that webinar the safer straddle, which was really not a name of a strategy. It's really an iron, it's a reverse iron butterfly or a reverse iron condor. And I named that webinar the safer straddle. It'd be well worth your time looking that up. So anyway, here's the trade. Well, let's do the back test on this, because I really want to illustrate. It's been a long time, I think, since we illustrated the capability of our back tester. So let's go to Option Slam. Under the back testing tab, we've got the OSBTT. This is the Option Slam back testing tool. And I think I have it open. Yeah, I have it open here already. And all we need to do is put in the stock, FL, and then we go to the date, November 28th. Let me make sure of something before we do that. Yeah, here it is, Foot Locker. What was the November 29th before the open? Okay, same as Okta. Okay, same as Okta, November 29th before the open. Perfect. So we want to trade this November 28th before the close. So we load that. We got to click this button, load strikes and expiry dates for Foot Locker on 11/28, and it took a little longer than usual, but it loaded up. Foot Locker, entry date, 11/28/2023. Stock price, $23.84, right between the 23.50 strike and the 24 strike. Okay, select a combo. Well, we're going to select, we're going to select the Iron Condor. Okay. To back test an iron butterfly as well as an iron condor, a reverse iron butterfly as well as a reverse iron condor, you want to choose iron condor. That way you're going to get access to calls and puts. Don't choose the butterfly, because that will be all calls or all puts. Choose the iron. Okay, choose the iron, because you both calls and puts. Okay, without saying any more about that, let me move on. And let's get a long iron condor, not the normal, regular, what most traders do, short iron condors. We're not selling those strikes closest to where stock is trading. We are buying those strikes and selling the ones that are further out of the money. The opposite of a short is a long. And select the expiry date. Let's select the December 1st, front week weeklies, only a few days away. And then let's see. This little table here tells you what, which strikes to put in which labeled field. 1, 2, 3, and 4. Okay, so here's the labeled fields. My closest to the money are going to be, and the software did it for me. It guessed at what strikes I want. The 23.50 put and the 24 call. It got it right. It just picks the closest strikes. So I don't need to modify those, but I do want to modify the ones that I'm buying, that I'm selling, the further out of the money. And so I'm going to go out to the 21.50 on the put side. And I'm going to go up to the 26 on the call side. Boom. And we're done. That's it. That's how you set up a trade in OSBTT. Very easy. Very, very, very easy, right? And this other field you just leave blank, because this is for the horizontal trades such as calendars and diagonals. We aren't working with those here today, so that is why that is grayed out. We chose the iron condor, which is composed of verticals, all options expiring in the same expiration cycle. So we click this button, Run Trade, and we get this these results. We can download this to Excel just like I did with the OCTA trade, but and let's do that a minute. Let's go ahead and download to Excel. We'll just click that button and we'll name this, let's name this FL. Enter. And that's it. And then let's look at our trade downloaded to Excel, and there it is. And then we just and then let's zoom in on this. Let's make this a little bit easier to see. Let's zoom. Let me highlight this and try zooming to 125%. Just let's do that. All right, there we go. So there now you can see there's that trade in OCTA. Excuse me, in Foot Locker. We were risking $142. That was the net cost. There's the long straddle or strangle, because they're not quite the exact strike. And then this sell, this side and this compose the short to reduce risk. And then this gives us an opportunity to, and then this stock actually went and made maximum profit for us. $57.50. So let's take a look at the price chart and see what that looks like. And let's go to FL, Foot Locker. And you can see here the stock was, let's zoom in on this area. So here is the day we put the trade on. And even though, and what was our strike? 26. We chose the 26 strike during the webinar last time, and that was perfect because price did not go much beyond that. And let's just say, okay, there's a question. Somebody's saying, well, what if you would have just done the long straddle? Let's do that quickly a minute, and let's see how that compares. So we'll close the all right, let's just do, all right, same trade day, same stock, but instead of iron condor, let's just buy the straddle. Same expiration date. And, well, let's not buy just the straddle. Let's buy the strangle. Let's change it to the strangle, let's buy the 2350, 20, there we go. Let's go long strangle. December 1st, 2350, 24. Perfect. That's exactly what we want. Let's run that trade. So now with that trade, and let's download that to Excel. And we'll call that FL long strangle. And we'll save that. All right, so now we have FL, the reverse iron condor, which we've already looked at. I'm trying to bring it. There's a reverse iron condor. And we risked in that trade $142. And we profited $57 on the first day, and we held it till close. Well, how do I get my percent of profit? Let me show you that. I just simply put in a formula here, which is going to be equals my return divided by my risk. Enter. And I got to put a little $ in there. so that I can copy this formula down. And then I can change these to percentage. And I can see that I made 40% profit against risk. A little less profit on day 2, but then on day 3, the final expiration date, 40% profit. Now, let's look at our other trade that we just downloaded, just the long strangle by itself. Open that up. Let's just, well, let me see. Let's open that up. Let's copy this into that other sheet so we can see them at the same time. Let's just copy that and find that other spreadsheet. I guess I could have put them side by side, but I'll do it this way. Paste that there. So here's the long strangle. And we're going to compare it to the iron reverse iron condor. In this case, as a condor. And let's use this same formula here. I think we can copy this formula and paste it right over here. Paste formulas right there. And then we can copy that down. And we can change those to percentage against risk. So here is the comparison. First of all, when we compare the safer straddle, what I call the safer straddle, compared to just a long straddle or long strangle, here's some of the differences. First of all, we're risking less money. $142 versus $342. And results are, in this particular example, now not every example is going to be the same. Some are going to be very different. But in this particular example, the safer straddle was the smarter way to play this given day 1, because I had 40% profit against risk on day 1 and only 11% profit against risk on day 1 over here. However, held to expiration, if you would have held, and not that you could, not that you should, or would want to, again, like I suggested, you want to go into day trading mode. All right, held to expiration, this one is capped. I can't make any more profit on this particular trade. It's capped at 40%. That's the most money I can make, and I hit my maximum profit target on this trade. That is the downside to the safety of this strategy. One of the downsides is that the profits are capped. Probably the only downside, as I think about it right now, in the way I'm thinking, that's probably the only downside. And I won't go into all. Go look at the Safer Straddle webinar to see all of the upsides to the Safer Straddle over just being long a straddle, especially at earnings time. But on expiration day, this long straddle actually outperformed. Why? Because the stock just kept going. And there is December 1st, and the stock just kept going, had a very strong day. and ended up here at the $29.73 zone. Okay. All right, enough on that. All right, let's try to get back to the topic at hand today. That was reliving a little bit about what we learned in the last webinar, and that was all about high EVR stocks. So let's get back to now today's topic is low EVR stocks. So let's go to our Option Slam stock screener. We ran our generic screener, and now we have Micron and Nike, which are not low EVR, but they're low compared to Foot Locker and an Oak Top, right? They're low compared to what we consider a high EVR stock. They're actually fairly normal, Micron and Nike. All right, so let's take a look at, if you just right click and open link in a new tab, it's going to take you to a Micron page where you have all of these pages available once again, and you can evaluate where is Micron. Micron is sporting a EVR of 2.2, and EVRs are coming down lately. See that? The EVR trend is down to kind of flat. You can see the last 4 EVRs are all right here at the same 2.2 level. So EVRs have kind of come down and now they're flattening. So we're not really expecting a move much different than the recent moves of, let's look at the closing. I like to look at closing. I prefer closing rather than the extremes of the day. But some traders want to see both, so that's why we supply both. So the closing move has been 4%, 7. There's a big move. 3.4, almost nothing, less than almost 0%. A 3%, a 3.5%. There's a fairly good move for Micron. But you can see that's the biggest move on the sheet. Now we have 9 more pages of data, but let's move on to the implied move page. Now, one thing that I think a lot of people missed in the last webinar, one thing that I think a lot of people missed is that I was trying to talk about when you evaluate implied move data at optionslam.com, let me put it this way. You are going to be trader A, and there's also trader B. There's 2 mindsets I want to point you to that I think a lot of people missed this point in the last webinar. And that is, I want to compare implied moves, this stock's normal implied move, to help me determine which strategy I'm going to go with. And trader A might look at, so let's see, Micron is not the greatest example because it's kind of flattened out. How about Nike? With Nike, to stay right on this implied move weekly page, I'm going to type next to the blue button here instead of the red. The red button is going to just take me back to the earnings history page, but the blue button is going to keep me on implied move page. So I'm going to just type in here, Nike. Hit my enter or click that blue go button, and now I'm on implied move. Nike's got a little higher EVR than Micron. A little, it was at the 3.7, I think, or so, or 3.4 or whatever. What is it? Let's see, we got it right here. 3.1, it's a little higher than Micron. So let's see. The point that I want to illustrate is I want to look at today's implied move for this upcoming earnings coming up on December 21st. Mind you, that is not today, that is not tomorrow, that is day after tomorrow, after the close. I want to look at the implied move, and this is not the final implied move. This is the latest one we have. Tomorrow there will be a new one put here, and the next day there will be a new number put here. Okay? I want to compare that to where have implied moves been in the past? And I want to think about trader A and trader B. 5.8 compared to the past implied moves. 5.9, 6, almost 8, almost 8, almost 8, over 9, almost 8, 8, and 6.5, we'll call it. Where is the implied move now? It is low implied move compared to all of these others. Trader A is going to say, oh, well, I can buy premium on the cheap. Maybe I should play for the larger move and do something like a reverse iron butterfly because I can buy the straddle cheap compared to any of these other earnings events when implied volatility was high, which caused the implied move to be high. Trader A is thinking I can maybe get premium on the buy premium on the cheap and enter in and play for the larger move. Notice we provide some data. Here's another earnings event where the premium was on the cheap compared to previous implied moves. And sure enough, that stock moved outside the implied move. But when you have an expensive, now here's some examples of expensive implied moves where it still moved outside. But to illustrate my point, here's the most expensive implied move. And what happened? The stock did not move outside. It stayed inside. So buying premium would have been a losing trade on it. In fact, there's stats here to show you, had you bought the straddle, how much money you would have lost. So trader A says I could buy premium on the cheap here. Trader B says, well, this is a lower EVR stock. They're not pricing in a very much of a move at all. Maybe I should consider playing for what the options market is pricing in, and that is a non-move, and just go with the normal iron condor rather than a reverse iron condor. So again, I tried to talk about this. I don't think I got my point across. You can interpret this data one of two ways, either from the mindset of trader A or from the mindset of trader B. Okay, hopefully I got that out. Wow, we are so far, we're already out of time and we haven't even gotten it. So let me ask you guys, are you of the mindset, looking at Nike, of the mindset of trader A or trader B, given this information? Now, this isn't all the information that we want to take in and assess. I went through a list of all of the things that we want to keep in mind when designing option strategy. But are you in the mindset of trader A or trader B? All right, so most people are suggesting, let's see, trader B. Let's play for the non-move and see what. Now, here's the problem, the issue that trader B faces. Trader B is going to be selling premium and not getting a lot of money in terms of implied volatility for the risk that he's taking on. I'm going to talk about a little bit more about trader A and trader B again. If we were dealing with this 9%, okay? If we were dealing with this 9% implied move, Trader A would say, well, that's expensive premium. I might not want to buy the reverse iron because the straddle component of the reverse iron is very expensive. Where Trader B might say, hey, this is an opportunity to get paid a lot of money for a regular iron condor. Okay, so again, this is just another illustration. So let's go over to now Thinkorswim. Oh, I'm curious, by the way, how many of you have not been switched over to Schwab yet? How many of you have not been switched over to Schwab yet? Everybody I know has been switched to Schwab, but I have not been. They have kept me at TDM Trade for some reason. So they told me that I will be getting switched during the year of 2024, but they said probably early spring. So that isn't that crazy? They love me so much at Thinkorswim, they don't want to let me go. It's the only thing I can think of. Over at TD Ameritrade, I should say. Okay, so here is Nike, and it's been on a tear since the last earnings event. Interesting. Been on a tear since the last earnings event. Okay. Playing for a huge move or not? Okay, Trader B says, let's try the Iron Condor, or the big brother to the Iron Condor, selling a Strangle. What's the implied move over at, let's design the strategy. The implied move weekly, implied move weekly, currently is about 6%, okay? About 6%. So 6% of 120, what is it? 120, we'll call it $123. 123 times 6% would be about a $7 move, okay? So let's go about $7 away from where the stock is trading. We'll go 122 plus 7 would be 129. We'll sell the 129 strike, and we'll go $7 away from the, to balance this, we'll go from the 123 down, and because stock is trading right in the middle between the two. So we go $7 up from the 22, $7 down from the 23. That gets us perfectly balanced, and that's going to take us down to the 116. So now we have a balanced short strangle. Let's see what that looks like in risk profile. And it looks tempting, interesting, even though we know that implied volatility is not very high right now compared to previous cycles, compared to previous earnings events from our work that we just did at optionslam.com. However, selling this Strangle does bring in a $239 credit, okay? And if the stock is in between this point and this point, we have profit. What is the theoretical probability of profit? Huge. 48 plus 48 is 96% theoretical probability of profit. However, the problem with this trade is that if on the off chance price goes beyond my break even, then my losses are theoretically, hypothetically unlimited all the way to zero. So a huge move here. And here's another thing that you can use OptionSlam for, and that is how often does this stock have a huge move? Well, we just have to go and look at the earnings history page at Option Slam on Nike. Just click on the earnings history page, and we can see there was a 12% move. Let's see. That was December 20th of 2022. Let's go to the post-earnings page and let's look at that December 20th. Here it is, December 20th, 2022. The one-day move was 13%, and it held that move. It just held steady for about 2 weeks, and then it started moving up even higher, okay? Then it started moving up even higher to 22%, 24%. So this was back. That was the biggest move I see on the screen, other than all the way back to 2021, June of 2021. And that was slightly bigger at 14% one-day move, 15% one-day move. And it did a very similar thing. So this is the utility. This is the functionality that you can find in the data at optionslam.com. When this stock moves huge, it consolidates that move for a couple of weeks, and then it starts moving up even higher and higher and higher in the next few weeks. So all great information, wrapping your head around how this stock behaves at earnings events. Back to our trade that we were designing. Well, we were going to go with the Iron Condor because Trader B doesn't like to take on unlimited risk. So to convert this into the Iron Condor, Trader B is just going to go and say, well, you know what? I'm going to reduce my risk here, and I'm going to buy something. Let's go out to the 112. I'm going to go 4 strikes below our 116. I'm going to buy that, and I'm going to go 4 strikes above our 129. Is that 4? 33, 132, 33. Yeah, I can still do math. And we're going to, I wonder why that cell didn't, I went 4 strikes below the 116 and buy that. There it goes. There it's populating. There it worked. And then over here, I'm going to go 4 strikes above the 129, and I'm going to control key, hit that, buy that Strangle. So that eats up almost half of my credit from the selling the Strangle, but it still leaves me with a decent looking Iron Condor where I can make $134 by risking 266 as opposed to risking unlimited amounts of money. Here I know the worst case scenario is a $266 loss. So I'm collecting, this is going to bring my break evens in a little bit. Going to bring my break evens in a little bit on each side. Okay, so I give up a little bit on the probability of profit, but I still have a very huge probability of profit with about 94%, about 94%, 93% probability of profit in this setup. Let me see if I'm set up correctly here. Let's change this to Friday the 20. No, it's set up correctly. It's set up there correctly. Yeah, Friday we could change this to the 23rd. Either way, the expiration risk graph is correct. So there you go. There's the regular short iron butterfly on Nike from a Trader B type of a perspective. Okay, I see a couple comments and questions. I was switched in November, okay, and so was I, Michael. I've been with Thinkorswim ever since. I've met him a couple times. I've never met him in person. When they started. Yeah, I've been down to the floor several times. I've been down to the CBOE floor back in the day when it was crazy. We used to go down there. I was with a trading group. Interesting little side story. I was with a trading group, and we went down there for an annual trip. We went down there every year because it was so much fun. Yeah, cool. All right. Well, that's great. We're over our time allotment here today. I do remember what I told you I wanted to remember, and that is to wish you all not only a great holiday season coming up, but I want to wish you all good trading. See you in 2024.